We're approaching 2 p.m. here on the East Coast, and that means the Federal Reserve in moments will announce its first interest rate decision of 2024.
Well, we always get very excited about Fed Day. Today might not have any major developments. Financial experts are widely predicting that the Fed will begin cutting rates this year, but not today. The central bank is expected to leave its policy rate unchanged for its fourth consecutive meeting. Now, this, of course, means that interest rates will remain at their highest level in more than 2 decades.
Now, the Fed is expected to hold rates steady, and that's despite not reaching its target inflation rate of 2%. As you see on your screens, the latest CPE price index, the central bank's preferred measure of inflation, shows prices rose annually to 2.6% last month. So what should we make of all this? CBS News business analyst Jill Schlesinger joins us now here in Studio 57, which is always a treat. Jill, we've set the stage there, but why is the Federal Reserve expected to basically do nothing, and why is that news?
Well, I'm guessing that they're going to be talking about the NFL, but that's a whole separate issue. But okay, remember what the Fed's job is. The Fed has a really unique position, an independent body that is supposed to make sure that interest rates are high enough to kind of quell inflation. And that's been good. As you said, inflation, the rate has been coming down. I know prices are still high, but if the inflation rate had peaked in the middle of 2022, it's come down by lots of different measures. And in fact, if you look at the last 3 or 6 months, we've seen a lot more progress on inflation. So they want to leave rates high enough to keep that inflation rate coming down. Now, here's the risk. You keep rates high for too long, and all of a sudden, the economy starts to freeze. And that can be seen as maybe some people are saying like, oh, I won't hire more people, or I'll lay people off, or maybe consumer demand starts to go down, and maybe parts of the economy just start a slow walk. And that can actually be the beginning, the seeds of a recession. So the Fed is saying, we got to keep rates high enough, we want to get that inflation rate down. We don't want to keep them high for too long. We don't want to cause a recession and job losses. And so I think they want a little bit more data before they say, OK, we're ready to start cutting rates.
And we do have that news in from the Fed right now. As widely predicted, they are, in fact, holding steady. So, Jill, you know what? I think that it's actually worth pausing for a second and talking, as you're discussing the interest rates. There's also the inflation rate. And while that has slowed, people are still seeing high prices, and it's not necessarily computing that the inflation rate is different than just prices.
Well, it's funny because one person would say, like, well, wait a minute, we're making great progress. Another person would say, yeah, but prices are still high. So we complain when prices were high, like gas was over $5 a gallon. And people would say to me, well, you see it every single day when you go fill up your car. But they don't say, oh, I'm so psyched, it's only $3.25 or $3.50. And so there are moments where you say, you discount the good news. I do think it is fair to point out that prices from before the pandemic, if you go back a few years, prices are actually higher overall. That happens, right? Because every year we do have some inflation, so prices do go up every year. It's kind of like we got a decade's worth of the pre-pandemic inflation rate in like 3 years. So if you say to me, how are consumers doing right now? It depends. If I have a job where I got a big raise over the last few years, chances are, if I'm in the lower half of income earners, those people actually have been okay because their wages went up by more than prices have gone up. They got more than a 20% increase. However, if you're in the middle and you didn't get a wage increase, or maybe you said, I just want to work home a day a week and I'll keep my wages fine, inflation spikes, you're in trouble. At the end of the day, each family feels it differently. But one of the big challenges with inflation, and it's why economists and the Fed hate it so much, is it kind of implants in our brain. We have a hard time letting go, even when the news does turn better.
So it really does depend where you are in the economy based on how you think things are going. So give us a bit of a reality check. You have this news now. The Fed is holding interest rates steady where they are. We're going to look very closely at Chair Powell's statement to see how we can read the tea leaves of when there might be a cut down the line. But we saw a robust labor market in 2023. This year seems to be taken up by a lot of headlines of layoffs at major companies. Where are we in reality, and what does that have to do with this decision today?
We see a lot of big name companies laying off, and part of that is what they're calling right sizing. I mean, you've been downsized and lost your job, so it doesn't feel right if you're the one who lost your job. That said, a lot of the big technology companies, they loaded up on employees. I was just looking at this because I went back in time. I said, well, how many employees did Amazon have back in the end of 2019? It was about 800,000 global employees. They ballooned up to 1.6 million by 2021 when everybody was buying online. They're shedding some of those jobs. They're not going to be at 1.6. They're shedding maybe 100, 150,000 of those jobs. So does that mean the technology sector is in decline? No. But there are some industries, media, which are in decline, where you have job losses that are not coming back. Or if you work at a local newspaper that shuts down, that job is not coming back. So what I would say about the economy is, you know, not unlike the housing market where it's location, 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 it is industry by industry. You are correct. The labor market was far stronger than expected last year. It really was. And we saw job creation slow down towards the end of the year. We see that we'll have a jobs report coming out this Friday. We're expecting, I don't know, maybe there'll be 150, 160,000 jobs. If it's a minus sign, people are going to be freaking out. They're going to say, oh, my God, I'm scared of recession. The Fed kept rates high for too long. And if it's way more than that, people are going to say, oh, my God, the Fed has to keep rates for higher for longer. At the end of the day, we don't know. I think the Fed is going to cut rates sometime this year. Maybe it's the March meeting. Maybe it's the May meeting, a little bit. But there'll be more data. Guess what? We don't really have to worry. If you're an investor, the stock market has been just blowing up on the upside in the last 3 months. You're happy. If you own a home, your equity has been increasing. That's great news. If you have a job, that's great news. If you don't have a job, that's bad news. So it comes down to almost person by person. I would really advise people to stop really trying to interpret the headlines, stick to your game plan. And look, if you're working in an industry that's consolidating, you'd have to be a moron not to be looking around and saying, what are the places that are hiring? Where can I go? What happens if? Someone called my podcast today and they said, my company was just taken over by another company and I'm scared I'm going to lose my job because the new company doesn't need all of us. So I said, have you looked for a job? He goes, not yet. I said, start looking for a job. Because these are the things you can do to protect yourself. It's also why we want people to have an emergency reserve fund. It's also why we want people to try to pay down their credit card debt. It's also why we want people to just do automatic investing, get on a game plan so that you're not blindsided by something. The things that you can control, great. The things you can't control, I'd stop worrying about them.
Great message.
Good advice in life. Jill, I really liked you sort of saying that it's industry by industry, person by person. Who are some of the winners and the losers by the Fed's decision not to lower rates this go round?
Well, I mean, if rates are high and you're a saver, you are ecstatic. You are ecstatic because you say, oh, my gosh, I'll still make money. I'll still earn more interest on my high yield savings account. I will still be able to lock in a CD, a certificate of deposit, at a higher rate. And who would do that? Well, maybe if you know you have to pay a tuition check in 6 months, I'd say, okay, I have $20,000 check. I got to write. I'm going to put $20,000 in a 6-month CD. I'm locked in. Maybe you think you're going to buy a house within the next year and you want to stash that money and have it available to you. You want to make sure that you can take advantage of high rates for as long as they last. What I can say is this will not be the case for the whole year. I think you'll look back on this time and say, oh, gosh, I wish I had my safe money locked in. And you have an opportunity now. You're not at the peak, but you have an opportunity. If you're looking for a mortgage, just remember, the Fed does not directly influence mortgage rates. Mortgage rates are still high, but they have come down by a full percentage point since the peak in the fall. And interestingly enough about those mortgage rates, just the idea that the Fed could start to cut and the interest rate cycle is going to change is going to bring down mortgage rates. And so that's great news for home buyers, still a very tight housing market.
So all that considered then, Jill, especially as you say, hey, focus on what you can control. We don't know when the Fed might cut rates, if at all, later this year. But it sounds like you're saying that if you've got money that you don't need soon, keep that in a high yield savings account. Maybe you get a 5% return on that. If you know you won't need money for a longer amount of time, still consider CDs, certificates of deposit, because their rates will decline later
Well,
this year.
I would say this. If you know you need access to money no matter what, and that's the most important thing to you, keep it in a high-yield savings account. If you know you've got a time horizon that's within a year or 18 months or 2 years, you can put it into a CD. If you don't need your money for 5 years or 10 years, and you somehow thought you knew when to time the stock market, you know you couldn't. And so what that means is you've got to get a game plan together to get your money reinvested. One thing I can tell you about these layoffs that you mentioned, as much as it is just painful if you're on the receiving end of it, if you are an investor, you will notice that every time a company announces layoffs, the stock of that company rises, because that company can no longer keep prices high in order to make money. So how are they going to keep delivering earnings to their stockholders? Well, anyone who has a retirement account as a stockholder, they're going to cut. And that stinks if you're the person being cut. But if you're an investor, you are actually the beneficiary of these cuts.
All right. Jill Schlesinger, so good to have you on this Fed Day. Thanks.
Great
Thanks,
to
Jill.
be here. Thank you.